We are living in a moment where monetary foundations, industrial transitions, and market psychology are converging in ways we haven't seen in decades. Gold and silver are not simply glittering commodities. They are becoming the barometers of trust in a rapidly changing global system. When structural shifts begin to reshape the economy, when debt ceilings lose meaning, when digital currencies rise, and when central banks subtly signal that fiat credibility is being tested, the assets that stand outside the traditional financial framework start to reprice. That is precisely what we are witnessing now. Gold and silver are no longer reacting to short-term inflation data. They are responding to long-term structural dislocations. Consider what's happening underneath the surface. Central banks across emerging and developed markets are increasing their gold holdings to historic levels. This is not a reactionary move, it's strategic de-dollarization. They are hedging against policy uncertainty and the slow erosion of purchasing power. The global financial architecture is tilting toward a multi-reserve world, and gold sits at the center of that evolution. Every ton added to a central bank's vault is a quiet vote of no confidence in the durability of fiat promises. That dynamic by itself could push gold past the $4,000 threshold within the next 18-24 months. But the story doesn't stop there. Structural demand in technology, electrification, and sustainability is giving silver a dual identity. Historically, silver mirrored gold's monetary behavior, moving higher when trust in fiat eroded. Now it's also a critical industrial metal powering the next era of innovation. Solar energy, electric vehicles, 5G infrastructure, and advanced semiconductors all rely on it. This combination of scarcity, utility, and monetary relevance has rarely existed in tandem. We're not just seeing investment demand, we're seeing technological dependency. That means even a modest tightening of supply or disruption in mining output can create exponential price reactions. The setup resembles early-stage exponential growth curves seen in emerging technologies: slow recognition, then rapid repricing. Capital markets are beginning to internalize this structural shift. The probability that we see another decade of easy monetary policy, low rates, balance sheet expansion, and financial repression is extremely high. When capital costs remain artificially compressed while debt levels expand, the store of value narrative strengthens. Precious metals thrive in that regime. They are, in essence, insurance against policy error. Every policy meeting that hints at slower tightening or premature easing increases the perceived probability of inflation overshoot, and gold instantly recalibrates. Investors aren't just buying ounces. They're buying optionality on future instability. We also have to recognize that the structural supply side is constrained. Years of underinvestment in mining infrastructure have left production capacity stagnant. Exploration budgets have been cut, permitting timelines have lengthened, and environmental regulations have tightened. Yet global demand from central banks, retail investors, and industries is accelerating. When an asset class faces a structural imbalance between rising demand and constrained supply, price elasticity becomes extreme. A 1% swing in global demand can trigger double-digit moves in price. That's why institutional models projecting gold at $4,000 and silver potentially near $80-100 are not sensational. They are mathematically plausible. There's a psychological dimension as well. Market participants are increasingly reevaluating what constitutes safety. For decades, safety meant cash and bonds. Now, with real yields fluctuating around zero and sovereign debt piles expanding beyond GDP levels, the definition is shifting toward tangible stores of value. Gold and silver embody that shift. Once this behavioral change reaches critical mass, when portfolios across institutions, sovereign wealth funds, and family offices allocate even a few additional percentage points to metals, the demand shock will outstrip available liquidity. That's the kind of moment that redefines price ceilings. The upside targets that seemed shocking today could soon feel conservative because structural drivers, monetary, technological, geopolitical, and behavioral, don't move linearly, they compound. And when they do, they tend to reward those who recognize paradigm shifts early rather than those who wait for consensus confirmation. The metals market is preparing for that recognition moment. Across global markets, a quiet but powerful rotation is underway. Capital is moving not just toward opportunity, but toward safety. That shift is being driven by a combination of geopolitical volatility and monetary policy recalibration, two forces that are redefining the investment landscape for precious metals. When we look back at moments in history where gold and silver made their most dramatic advances, they were never in isolation. They were always catalyzed by the intersection of fear and policy, and right now, those catalysts are aligning again. Geopolitically, we're navigating an era where uncertainty is no longer episodic, it's structural. Conflicts are not confined to one region, they ripple across energy markets, trade routes, and digital networks. Tensions in the Middle East, Eastern Europe, and the Pacific are reshaping the global order. Nations are rethinking alliances, energy strategies, and even reserve compositions. In such environments, capital seeks neutral ground, and there's nothing more neutral than gold. Unlike a currency, it carries no counterparty risk. Unlike an equity, it doesn't depend on future earnings. It's pure optionality against instability. Each geopolitical escalation, whether it's kinetic or economic, becomes a spark that reignites, say, haven demand. We are also seeing the early signs of a deglobalization phase, reshoring of supply chains, restrictions on resource exports, and the weaponization of trade and technology. These shifts are inflationary by nature. They introduce friction, inefficiency, and duplication into global commerce. When production costs rise and supply chain fluidity declines, the traditional levers of monetary control weaken. Central banks, especially in developed markets, are now forced to balance two opposing mandates, fighting inflation while preventing financial instability. This delicate balancing act creates a policy environment where real rates struggle to remain positive. For gold and silver, that's the perfect storm. Monetary policy today is not about restraint, it's about management of perception. Even as central banks publicly emphasize data dependency, the underlying bias remains toward stimulus. Every sign of economic weakness is met with market expectations of rate cuts, liquidity injections, or new fiscal support. And every policy pivot weakens fiat credibility just a bit more. Investors are beginning to realize that inflation may not return neatly to 2%, and that negative real yields could persist longer than anticipated. In that context, the opportunity cost of holding gold and silver collapses. Metals become not a hedge, but a rational component of any forward-looking portfolio. The recent acceleration in central bank gold purchases underscores this shift. Nations that once relied on dollar reserves are diversifying quietly, strategically, and persistently. The People's Bank of China, the Reserve Bank of India, and even smaller economies are accumulating bullion, signaling a long-term move away from singular currency dependence. This isn't a speculative trade, it's a reallocation of trust. Every ounce purchased represents a recalibration of global power, away from paper promises and toward intrinsic value. When that movement becomes visible on balance sheets, it amplifies confidence in metals and accelerates capital inflows from institutional investors who typically follow central bank behavior. In the same breath, silver's correlation with gold tightens during these macro shifts. As monetary policy turns accommodative and risk premiums expand, silver benefits both as a store of value and as an industrial input for the green transition. It becomes the high bait to play on monetary instability, more volatile, but more explosive. Historically, when gold rallies due to geopolitical stress or policy easing, silver eventually outperforms in percentage terms. we are beginning to see that pattern emerge again. What makes the current cycle extraordinary is that geopolitical and monetary policy dynamics are no longer cyclical, they are systemic. We're witnessing the erosion of confidence in both global peace and central bank omnipotence simultaneously. That dual erosion is rare, and it's fueling a quiet reallocation toward tangible assets. Investors are not merely speculating on price, they are hedging against a world where predictability is vanishing. In that world, metals don't just shine, they lead. When gold begins to surge, silver doesn't just follow, it accelerates. It's the leverage play within the precious metals complex, the one that turns conviction into exponential outcome. Historically, silver has lagged gold at the start of a major bull run, only to overtake it once confidence broadens and liquidity floods in. That dynamic is resurfacing now. As gold establishes new highs, capital rotation toward silver is picking up momentum, and what's often dismissed as a secondary asset could soon become the star performer of this cycle. The foundation of this potential lies in silver's dual personality. It is both a monetary metal and an industrial workhorse. That hybrid nature means silver sits at the intersection of two major macro currents, the revaluation of real assets amid monetary uncertainty, and the transformation of the global energy and technology landscape. On one side, you have investors seeking protection from currency debasement. On the other, industries demanding more silver than ever for electrification, solar, and advanced electronics. This convergence creates a feedback loop where investment demand amplifies industrial scarcity, and vice versa. Technically, silver is still undervalued relative to gold. The gold-to-silver ratio, currently hovering around multi-decade highs, signals deep asymmetry. Historically, when this ratio stretches beyond 80, it doesn't stay there. Reversions often coincide with silver outperforming gold dramatically, sometimes doubling or tripling in price within a relatively short period. If gold were to stabilize around $4.000 an ounce, even a conservative reversion in the ratio could imply silver above $1.80, while a stronger cycle could push it toward triple digits. What appears speculative at first glance is actually a reversion to mean when viewed through the lens of historical elasticity. Another critical layer is supply constraint. Unlike gold, which is predominantly mined for its own sake, most silver production is a byproduct of mining other metals, zinc, copper, and lead. That means even if silver prices soar, production cannot easily ramp up without broader increases in industrial metal output. Meanwhile, global above-ground inventories are thinning, and new mine projects face years of permitting and financing hurdles. As demand intensifies, both from investors and industry, the supply elasticity is near zero. This imbalance is a classic setup for parabolic price action once capital inflows reach critical mass. Institutional awareness of this imbalance is increasing. Funds that once ignored silver as a niche exposure are now reassessing its risk-reward profile. Exchange-traded products tied to silver are seeing renewed inflows, while major mining equities are beginning to outperform broader indices. This institutional pivot matters because it introduces scale. Once capital recognizes silver not as a speculative trade but as a structural allocation, its liquidity profile changes. Price volatility will remain high, but so will upside convexity. The technological layer adds another dimension. The clean energy transition is silver-intensive. Solar photovoltaic cells, EV circuitry, and high-efficiency electrical systems all depend on silver's unmatched conductivity. With policy momentum building globally toward decarbonization, the demand curve for silver is shifting upward permanently. The International Energy Agency projects that silver use in solar manufacturing alone could double within the decade. Combine that with investment-driven demand, and the market faces a structural squeeze not seen in modern times. Psychologically, silver tends to ignite retail enthusiasm once gold captures headlines. It's the democratized play, the asset that retail investors can access without large capital commitments. This behavioral dynamic has the potential to accelerate momentum once mainstream narratives catch up to institutional positioning. During previous cycles, that retail wave has been the catalyst for the final explosive leg of silver's rally. What we're seeing is not a speculative mania in its early stages. It's an underappreciated re-rating of an asset positioned at the crossroads of monetary transformation and technological evolution. As gold confirms the thesis, silver amplifies it. And in this cycle, the asymmetry is sharper than ever: constrained supply, expanding industrial use, accelerating capital flows, and a psychological pivot toward tangible value. When these forces align, silver doesn't just mirror gold's advance, it multiplies it. The market is entering a phase where asymmetry defines opportunity, and nowhere is that asymmetry more visible than in precious metals. The risk/reward setup today is profoundly tilted in favor of gold and silver, not because sentiment is euphoric, but precisely because it isn't. Investors are still underexposed, institutions remain cautious, and policymakers are trapped in a cycle of intervention. When fear of missing out meets systemic fragility, price discovery tends to happen quickly, and often violently. That's the inflection point we're approaching. The perceived risk in metals is largely backward-looking. Many investors still associate gold and silver with periods of inflationary panic or speculative bubbles. But today's setup is structurally different. This isn't about a short-term hedge, it's about a long-term recalibration of global value storage. Central banks are net buyers, supply chains are constrained, and trust in fiat systems is waning. These are not transient conditions, they are persistent. The upside scenario is therefore not contingent on crisis alone. It's reinforced by slow, grinding structural shifts that the market is only beginning to price in. On the risk side, what are the genuine threats? A sustained rise in real yields or an unexpected resurgence of economic growth could theoretically pressure metals in the near term, but even those headwinds are less potent than they used to be. The global debt load now exceeds $310 trillion, meaning central banks cannot afford to let real rates rise meaningfully without triggering financial instability. Each attempt at normalization has been met with liquidity injections and dovish pivots. This dynamic effectively caps the downside for metals. If growth slows, rate cuts follow. If inflation rises, gold and silver hedge purchasing power. In either outcome, metals maintain relevance. That's the hallmark of asymmetric positioning: limited downside, expanding upside. Moreover, the long-term volatility profile of gold relative to equities and crypto assets is stabilizing. In a world defined by algorithmic trading, liquidity shocks, and geopolitical unpredictability, the value of low-correlation assets increases. Portfolios optimized for stability are beginning to integrate gold as a core holding, not an accessory. For silver, the volatility is higher, but so is the convexity. It offers leverage to the broader thesis, an intelligent way to express conviction in the same macro narrative with exponential potential. Investors who recognize that difference are strategically allocating now, while the market remains distracted by short-term narratives around tech cycles and monetary pivots. Capital efficiency also matters. With mining equities historically undervalued relative to spot metals, the embedded optionality is extraordinary. Many gold and silver producers are trading at cash flow multiples that imply flat or even declining metal prices, an assumption misaligned with macro fundamentals. When sentiment shifts, the re-rating potential in these equities could outpace the underlying metals by multiples. That's where sophisticated investors are positioning quietly before the liquidity wave arrives. Another often overlooked component of the risk/reward equation is time horizon. Most investors underestimate the compounding effect of persistent undervaluation in real assets. Holding metals through cycles has historically delivered not only absolute returns, but protection during systemic resets. In a world where digital assets remain volatile, bonds underperform real yields, and equities depend on liquidity injections, the relative stability of tangible value is a strategic anchor. The irony is that gold and silver don't need extreme scenarios to perform. They simply need the current regime of policy uncertainty and debt expansion to persist, and all evidence suggests it will. Behaviorally, this setup is also compelling. The market is still in disbelief. Analysts label every rally as overbought, every correction as a top. That skepticism is a feature, not a flaw. It means we are early in the adoption curve. As mainstream capital begins to accept that inflation may remain sticky and monetary tools increasingly blunt, gold and silver will transition from being trades to being strategic assets. When that recognition phase begins, price acceleration tends to outpace analytical models. The skew now is extraordinary, minimal downside protected by structural support, and a potential upside driven by monetary, geopolitical, and behavioral convergence. This is not about timing a breakout, it's about positioning for inevitability. When macro systems bend under the weight of debt and policy exhaustion, value migrates toward assets that don't rely on promises. Gold and silver are precisely those assets. And for those able to see beyond the noise, the math speaks clearly. The reward now vastly outweighs the risk.